Hey everyone, welcome back to the channel, your number one source for income-oriented investing. In today's video, I want to tell you why, as you probably noticed lately, why I'm ditching most of my Canadian stocks or Canadian companies. Now, I just want to be clear, I'm not talking about Canadian listed funds or Canadian listed stocks, right? I'm talking about actual Canadian companies, Canadian stocks, right? So you notice in my last couple of portfolio unveils, I ditched funds like Utes, which is Canadian utilities. I trimmed my bank position, and it seems like, not that it seems like, right now my portfolio is pretty much 98% concentrated in US stocks, US companies and indexes, right? So I want to tell you my reasoning behind this change that I've made, and because this is pretty, important information, and these changes I'm assuming are going to be here to stay for a long time. So again, just to make sure we're on the same page, I'm not talking about Canadian listed ETFs. I'm talking about Canadian companies themselves. So reason number one, this is very important reason for me as a non-resident of Canada now. It's because of my tax situation. So obviously you guys know that my general portfolio, my main portfolio, now that my RSPs are gone and my lira is going to go away as well, is basically 80 to 90% the joint cash account. It's just a regular non-registered account, right? And then there's the two TFSAs. And my tax situation is a big reason because as a Canadian non-resident, I've talked about this a million times, guys, but I'll just reiterate it here. I don't want any eligible dividends, any income that's eligible dividends, because as a Canadian non-resident in the cash account, there's a 25% withholding tax right off the top on all my dividends, no matter what the source is. But the following year, the portion that's considered ROC and capital gains are refunded, because as a Canadian non-resident, you don't pay taxes on capital gains, and of course ROC income is not taxed anyway. But foreign income or interest income or Canadian eligible dividends, I don't get that back. I don't know why that is. That's just the rules. So this is really the reason why I'm a big reason, or a big part, where I'm not going to have, I don't want any Canadian companies in this cash account, which is now makes up most of my portfolio, because it's just not tax efficient for me, right? If 50% of the dividends, or 60-70% of the dividends, or even 25% of the dividends are considered eligible, Canadian eligible dividends, well, 25% of that is going to be taxed and I don't get it back, whether versus if it's capital gains or ROC, I pretty much get it all back. So it is a big deal the more eligible dividends there is for a particular ETF, right? So that's reason number one, very big reason. Reason number two, and this is probably the number one reason, the biggest reason I feel, the most important reason, is because Canadian stocks, Canadian companies always underperform the US market or US companies over the long term. Always, right? So this is not a matter of opinion. This is a matter of fact. Now, of course, I know that certain periods of time, the Canadian stock market could beat the American stock market, but I am not interested in a certain period of time. I am a long-term investor. I care about the next 10 years, 15, 20 years. I'm in it for the long term. So the truth of the matter is US stocks, the US market, beat not only Canadian market, but all markets worldwide. They're number one. So let's check out some proof right now. So here I have for you guys the TSX 60. So that's the XIU ETF. And we're going to compare it to the S&P 500 ETFs. And I even decided to put the, of course, we're going to use iShares or Vanguard index funds here, because that's just the best way to gauge. This is, the ETFs or the providers with the lowest fees, the lowest management fees, and they're basically just index funds. So XIU is the TSX 60, which is pretty much the S&P 500 of Canada. It's a good gauge to measure the overall stock market, the overall Canadian stock market performance. We're going to do versus VSP and VFV. VSP is the S&P 500 Canadian hedge. VFV is the S&P 500 not Canadian hedged, VFV. And we're also going to compare XEQT, which is the whole world. So you see, if we look at 10 years, you could see that the overall Canadian market has an average return of 8.79%. And by the way, I'm filming this on March 4th, so this is 10 years as of that date, I believe, or maybe a month before. End of February probably. And you see that the both S&P 500, of course, the non-hedged is doing much better, because basically if the Canadian dollar gets weaker and weaker versus the US dollar, the VFV is going to benefit, whereas the VSP would not benefit, or it's going to be negatively impacted. But either way, even the VSP is beating it. And it's a pretty big difference. This is, remember, average per year. If you actually do XIU versus VFV or VSP straight up in the Canadian stock channel total comparison return, you'll see a massive difference. So this is, if you do 14.28 minus 8.79, that's like more than 5%, but that's every year for 10 years. So it's like a 50% cumulative return difference. So the point I'm trying to show you guys is that over the long term, I think it's pretty well known and pretty proven that the American stock market is dominating every market in the world. And even XEQT, which is the whole world, if you will, we only have 5 years of data here, but it's 13.72 versus 18.20 or 15 here. So you see, even the whole world, because most of it is the United States, even ends up beating, in the last 5 years, the overall Canadian market. So I think really the proof is in the pudding. The numbers are right here. It's not a matter of opinion, guys. The US market outperforms everybody for the long term. Another reason that's really specific to covered call income investing is that the options market in the US is much bigger, much more liquid than the Canadian options market, right? So as a income investor that pretty much invests exclusively in covered call ETFs, well, covered call premiums is based on options, on the options market, on the volatility, on the options liquidity. And the biggest options market in the world by far is on the US. The Canadian, from everything I've heard from ETF fund manager, yes, there's an options market, but it's much less liquid, which means the bid-ask prices could be higher, right? So it's just a more inefficient options market. And this is important for us income investors that rely on covered call income. So that's definitely a reason. Reason number 4. Reason number 5 is, and I'm kind of sad about this, but it's not really a surprise. There's really not that much innovation or technology stocks in the Canadian stock market, right? Most of those companies are in the US stock market. Canadian stock market, what is it really comprised of? Mostly financials, energy, materials. There's very, very little innovation there. And I don't know, maybe I have a bias because I worked in the technology field all my life, but I really believe, it doesn't take a genius to believe that the future is technology, and technology in the future. I think we're going to need more technology in the future, not less. So I think these are very important stocks for growth in the future. Not only that, they're also pretty volatile. They're big and have a big options market. So this just adds to that. And you could see really the discrepancy if you compare the S&P 500, which is about 30%, 33% tech stocks. And I think that's only going to grow over time, versus the Canadian stock market, which is almost non-existent. There's a couple of technology companies. I think the one that makes up the most in the technology sector is Shopify. But besides Shopify, there's not much. There's maybe a couple of other ones. I think there's OpenText and Constellation. There's even CGI, which is the old company that my wife and I worked for over a decade. But even CGI, that's an IT services company. It's not an innovation company. They don't create anything. They just provide services. They're kind of like Accenture. So it's definitely not an innovation. So that's another point, right? There's just not that much innovation in Canada. The biggest sectors are financial and energy, which are both cyclical sectors. So I'm not saying that they're not good sectors, or we're not going to need banks and insurance companies and energy companies in the future. But I think technology is more important in the future. That's just my opinion. Last but not least, is that the US market, the US economy is just the most free market capitalist market in the world. Now, you could agree with that. it's not a matter of opinion. I think it is, but if it's good or bad, that's where you might agree or disagree. I'm just saying that as it correlates to the economy and stock market and performance, it's quite obvious to me that the more capitalistic, the more free market the country or economy is, the better it will do. So obviously Canada is not as free market or capitalist. It's a little bit more of a socialist country, right? So that just translates into the stock market performance. I think there's a direct correlation between the type of economy or system the country has versus the stock market performance. I think it's not rocket science, right? So more government intervention, more government control, and less just typically means less free market, right? Less capital goes in, or there's less motivation for international investors to invest in a less free market capitalist nation, right? So forget about opinions, guys. It's just proven. The more free market is embraced in the economy, the better it will do. And the US is simply the most free market. And why? In my opinion, it's beating Canada, it's beating Europe, it's beating the emerging markets. And I think it'll always be that way. So now so in the title you see with one exception. What is the exception? Well, as you've seen in my last portfolio unveiled, the only Canadian type of ETF or Canadian stock ETF that I have is bank. This is now exclusively only my TFSAs because there's no 25% withholding tax, so I don't have to worry if it's eligible dividends or capital gains and ROC. So I decided to keep a little bit in bank, which focuses on Canadian financial companies, 60% in the big six banks, but there's also Manulife, Sun Life, Great-West Life, and Power Corp. So why did I invest? Why am I keeping a little bit in bank and not just going 100% in US stocks? Well, once again, everyone, we're going to look at the proof. We're going to look at the numbers. And the reason is because the financials sector, the financial segment of the Canadian stock market always outperforms the overall Canadian stock market. It's kind of like technology as a sector, or the Magnificent Seven always beats the S&P or is beating consistently the S&P 500. Well, on the Canadian side, it's the Canadian financials is the sector that's always outperforming the overall Canadian market. So what I've done is I compared XIU, once again, the overall Canadian market, right? Top 60 stocks in Canada, diversified. I even added VDY in there, which is like 55-60% financials, I believe. But VDY is just a very, very popular Vanguard Canadian ETF that focuses on Canadian stocks, but Canadian dividend stocks in particular. So I just put those two as a reference. And we're going to look at, if we do versus XFN, which is by iShares, only the Canadian financial stocks, and I even put ZEB as well, which is just the six banks. You could see that, and again, I'm interested in the long term, guys. I don't care about 1 year, 2 years, 3 years. I care about 5, 10 plus. So you see that it's quite obvious that the financial sector, whether it's all the financial companies or most of them, and just the six banks, they tend to always outperform the overall Canadian market. So this is really the reason why I kept bank. I simply think that the Canadian financials are the best sector in the overall Canadian stock market. If we look at any other sector, if we look at the utility sector, the REIT sector, even the energy sector, you see that after 10 years on average, none of these sectors are beating the overall Canadian market. They all underperform. Now, of course, energy has been doing really well if you look at the last 5 years. But again, I'm in it for the long term, guys. I'm in it for the 10-year plus. And you could see that the utilities, the real estate, and the energy sector do not beat the overall Canadian market. Only the Canadian financials do, right? And then if we go up even further, the S&P 500 always destroys the overall Canadian market over time. So that's it, everyone. Maybe you thought I was gonna badmouth Canada or the Prime Minister or Canadian stocks overall in this video. That's really not the point. I'm above all that. I am an investor. I consider myself now more like an international investor. So of course I wish Canadian stocks would do really well, and I'm still Canadian at heart. But the proof is in the pudding, and numbers are numbers, guys. So one thing you should always ask yourself, and this is what I ask myself now all the time, I think it's a very important question. Before you invest in anything, remember, investing is for the long term. Before you invest in anything, always ask yourself, will this beat the S&P 500? Will this outperform the S&P 500? If you're pretty sure that it won't, well, maybe it's not worth it, right, over the long term. So this is always something you need to ask yourself. Even if you're a resident of Canada, especially for your registered accounts, your TFSAs, your RSPs, where it doesn't matter if you're getting foreign income or interest income or eligible dividends or capital gains, it all doesn't matter, especially for those accounts. Ask yourself, is what I'm investing in, and I know Canadians typically start with Canadian stocks, but you got to ask yourself, is this going to beat the S&P 500 over time? NASDAQ 100 over time? So always ask yourself that question going forward, everyone, especially for your registered accounts. For your non-registered accounts, I get it. If you're in a lower tax bracket, eligible dividends could be really good, could be tax efficient. But capital gains and ROC is very tax efficient as well. And the higher tax bracket you go, there's a certain point where capital gains is actually better than eligible dividends. I got a video coming up that I'm going to work on to talk all about that. Wanting eligible dividends in your cash account as a Canadian. I think there's a lot of misconceptions around that, so stay tuned for that video. But give me a thumbs up if you like this video, if you enjoyed it. These are the 5-6 reasons. I hope it was clear. And again, I'm not trying to badmouth Canada or Canadian stocks. I'm just focused on the reality as an investor, because you just want your money to grow over time as much as you can, whether it's covered call or not, guys. The performance is really always going to be based on the underlying assets, and they don't say the S&P 500 is king for no reason, right? It's just that the overall American market always beats every other market in the world right now. So you have to ask yourself, you got to consider that when you're investing for the long term. So again, thumbs up, I would really appreciate it. See you next time.